The
Can you
IPO
hear that?
calendar has heated up this week. The first one we're going to talk about is Taminco. Now, this company is hoping to raise $300 million in its IPO, and it's a company that's based with organic compounds, alkylamines, which is an ammonia alcohol-related product. Francis, when you take a look at the stock, you don't like it. You think that they're a little bit over-leveraged.
Right. It was acquired by Apollo in December of 2011. And after the IPO, it'll have a negative net worth of $500 million. And they have 7 plants spread around the world. It's kind of a regional business because there's the cost of freight makes a difference. They say they've upgraded their plant in the United States and are looking forward to great growth ahead. But if you compare 2012 results with 2011, everything's down. Sales down. The net income is down. Gross margin's down. The only thing that's up is EBITDA. So to me, that looks like Apollo is trying to use public money to bail themselves out of a bad situation. So what they're really saying is that it's the company participates in worldwide economic growth. And I think there are much better companies where you can leverage worldwide economic growth rather than this. It's a dull, boring, kind of stale company, and they can't do anything on their own to increase sales.
And then we have another company that's also very highly leveraged, and that's Fairway. A lot of people here in the New York area know it because it's a very popular grocery store. But your issue is that they want to raise $151 million, but they too are very over leveraged and have an accumulated deficit of $251 million. But people seem to be very interested in this one.
Yeah, they really do. And as you said before, it's in the food business. I think the issue there is that they have 4 stores in Manhattan and they have about 8 in Connecticut. And I think some of the money managers see both stores and they think it's a great deal. I frankly was quite surprised at the financials. This company has never made any money. It always has shown an operating loss. It's for the year ending 2012. They had a loss of $3 million, and on top of that, they paid $17 million in debt. It's a private equity deal, and only $51 million of the offering is going to open new stores. So I don't think they're serious about opening new stores. It's had probably the most hype of any company I've seen in the food business. What people do is they compare it with Whole Foods and natural grocers, both of which make money, and this one loses money. So it's never shown an ability to make money. It doesn't have a model that can be extended. I don't see why people are interested. I think what will happen is on the IPO, there'll be an initial burst of enthusiasm, but if anybody will look at the financials, they won't hold the stock very long.
All right, and it is rare that we see a wine company go public, but we've also got this week is Truett-Hurst, and you can find their wines at grocery stores like Trader Joe's and Safeway. It's a small deal. They only want to raise $38 million, but you're not drinking this one up either.
No, they're selling about 45% on the IPO. It's always a bad sign when you sell a high percentage on the IPO because it limits your future ability to raise money. It's in the premium and super premium wine area, and as you said, they're into Safeway for the 6 months ended in December. They sold $2 million to Safeway. They're trying to get into Trader Joe's, and according to the S1 filing, they're going to be trying to get into Walmart and some other big stores. So it's all in the come. The sales for the 6 months ending December were flat. The gross margin was up, but G&A was up 300%, which is too much. And then it went into a loss position. So they kind of made a mistake on the ramp up to the IPO. Maybe they should have waited until they had more of the retail sales. If they have their sales, it's a good deal, but they're not there yet, so I wouldn't risk it. This one's a Dutch auction. And the one that people most remember is Google. Google was a Dutch auction too. That's where they really don't set a price until all the people put in their bids for the stock. So it's interesting to watch, I think.
All right, so it sounds like if you are looking at one of these IPOs, Francis Gaskins, president of IPO Desktop, suggests you might want to not put them on your plate. And I'm Debra Borchardt with TheStreet.